chatting to Goolam Ballim, who's Chief Economist at the Standard Bank Group. Finance Minister Pravin Gordhan coming out and saying that he believes that South Africa has done enough to stave off a ratings downgrade at this point. Do you concur with the Finance Minister?
I fear that while much has been done and arrested over the last couple of months, perhaps we may just fall slightly shy, and I would suggest South Africa braces itself for the downgrade.
It seems huge that we would be downgraded to sub-investment grade. Do you really believe that it's a reality on our horizon?
It is material and perhaps suitable that there's some element of drama around it. Historical evidence suggests that whereas nations can slip from higher ratings within the investment category, it tends not to be as punitive. But certainly there is an asymmetric level of pain, punishment, when one goes from the investment cluster to sub-investment grade. So that's undeniable, and your level of angst is therefore well deserved. But if you look at the metrics with respect to South Africa's economic performance over the last couple of years, if you look at the hardly inspiring political economy, that certainly is unbecoming of a nation that wants to put building blocks in place for faster or accelerated growth in coming years. And you look at the absence of a clear, unambiguous and committed policy program, then perhaps we are at a place that we deserve to be for more clearer reflection and subsequent reformation so that we can once again perhaps ascend.
Key to this decision is obviously the growth in the South African economy, which is looking itself subpar at the moment. What are your thoughts in terms of economic growth in South Africa and where we will see ourselves for the rest of this year?
Over the last couple of years, South Africa's nominal growth rates have been pedestrian, as you allude to, so generally real rates of performance below 2%. Also, in the early years following the 2008 and 9 financial and economic recession, South Africa stuttered and didn't enjoy the same level of revival as peer markets. So not only did we underperform in the early stages of this recovery era, but we also lagged our peers, and more latterly we seem to have fallen into a slumber. Layering that first with a recognition that our economic performance at say roughly 0.5% this year, if we avoid a downgrade, is at least 1 percentage point below population growth. That suggests that per capita incomes are shrinking. So a nation with a very high unemployment rate in excess of 25%, and on wider definition in excess of 35%, a very substantial social program so as to alleviate poverty, but at the same time erodes agency, disempowers people from lending themselves more meaningfully to the labor force. That coalesces into a situation where purely on a formulaic basis, South Africa is stuttering. South Africa may even be hemorrhaging. And so it's right to be concerned, and perhaps our figures don't muster or augur well for investment status.
You mention a level of political instability in the country. How much of that is media hype? And how much of that is real?
I suspect that there's substance, deep-seated substance, to an uninspiring political economy. To the extent that there may well be noise and journalistic drama, but it would be foolhardy to believe that there is consensus within the ANC. It would be foolish to consider that the tripartite alliance is harmonious and singularly committed to a unified agenda. One can even go so far as to argue that the ANC has lost some level of legitimacy in Parliament by the nature of debates and the theatre that goes on. One can argue that the ANC has lost legitimacy in the streets when one looks at the 2014 election results and you look beyond the veneer of a 62% national poll and you look at the actual provincial outcomes. that the ANC, for instance, has slid so dramatically in Gauteng, in Tshwane, in Johannesburg, and even in Ekurhuleni by an average of 10 percentage points in the 2014 national count, or provincial count in this instance, and relative to the 2009 outcome. And then, if I could borrow from Trevor Manuel, and certainly I lack originality in this respect, he has signaled that the ANC has foregone some of its intellectual strength. So it's no more as towering a body as it once was. The ANC is going into the municipal elections on the 3rd of August for an election to lose, rather than necessarily consolidate its strength or even see an appreciation in its national representation, at least measured by municipal level.
So the rating agencies will also be looking at the strength of our institutions, which have always held up relatively well, even in the international space, and also looking at fiscal prudence. Again, I think we get a double tick on that account as well. Your thoughts as to whether we really are holding up in both of those elements?
It is right to celebrate that there is still deep-seated institutional integrity in a variety of our foundational pillars. So whether it is the South African Reserve Bank, whether it is the National Treasury as it currently stands, both in terms of its form, function and leadership. The judiciary has shown itself to be pristine in many respects over the last couple of months, and a bastion of committed governance. However, that is enveloped by the political economy. The political economy shapes the animal spirits, the appetite for risk-taking, and it can either be contributing to business risk-taking or subtracting. And over the last couple of years, the political economy, indecision, policy prevarication, stasis in some areas where business wants answers, such as the mining sector, that has only contributed to hesitation. So it's unsurprising that over the last couple of years we've had flat to negative growth rates, performance, in private sector investment. And in the absence of private sector investment, while we celebrate the pillars that uphold the economy and the remaining vestiges of strength, in the absence of a constructive political economy, there is not going to be risk-taking, investment, and even perhaps more lively spending, which effectively means a lame economy structurally for a length of time. So we need to rehabilitate the political economy, layer that, of course, and celebrate the foundations of good institutions, and then get the private sector bolted on in a constructive way.
The fiscal prudence. Talk to me about where we're going on that path.
So we've entered this very challenging period somewhat fortified. In other words, historical evidence tends to show that there's often fiscal relapse up until the downgrade. Some nations then reflect deeply and commit to fiscal probity. Others just find themselves on a slippery slope. So Minister Gordon had an opportunity in February to commit South Africa to reducing its indebtedness and reining in the fiscal balance, and of course they linked. And rather ironically, despite whatever narrative he was brought to power in December, the capacity to be able to do that has meant that we go into this decision with a deep-seated strength of fiscal commitment, with only a whiff of doubt surrounding whether we will remain committed. But it is after a downgrade, should it come to pass, that the commitment to fiscal consolidation, fiscal probity becomes even more important. And more important quite simply because it is likely that growth will degrade slightly further, and our debt metrics, simply by a mathematical sleight of the pencil, will likely worsen to the extent that there could be a downward ratcheting in growth projections, at least over the next 12 to 18 months. So the commitment to avoiding any malfeasance becomes even more substantial, and one needs that level of staunch participation. So the fiscal policy is critical, and for the moment it's in a safe pair of hands in that of Mr. Gordon.
Let's look at the two scenarios. We don't see a ratings downgrade from S&P. Obviously, Fitch is coming out with a decision on Wednesday next week as well. So let's say both rating agencies hold our current rating and downgrade further the outlook.
So what we should separate is our macro condition and the label that will be plastered by S&P, Fitch and Moody's for that matter. So our economic and political condition has been generally in degradation for the last couple of years, and market pricing, independent of the rating agency's adjudication, will seek to reflect that macroeconomic condition, the risk profile of a nation. And I've used a rather amateur analogy by suggesting that on our own metrics, we are in hospital and we are in high care. What potentially happens is when the rating agencies come along and certify your ill health status, just that very suggestion can potentially take you from high care to intensive care. So there is that proposition that the rating agencies, and S&P in particular, can be counterproductive in the sense that we have a nation that is potentially on the cusp of healing. Political reforms are already in train, and that reflects some level of rehabilitation in our political economy. It could be 2 steps forward and some level of retracement, but potentially more gains over time than relapses. And so they come with this adjudication at precisely the time when you want to perhaps give the political reformation cycle a chance to then engender a reformation in the macroeconomic cycle. And so what I'm suggesting is that we have a weak economy with tightened financial conditions. Tightened to the extent that equity prices in certain sectors have lost some of their earlier giddiness. Interest rates are higher, the rand is weaker, and aside from its aiding exports, generally that translates into tighter financial conditions. If S&P gives us a reprieve, those financial conditions to some degree will abate, to some degree will ease, and will lessen the level of headwinds. If we are downgraded by S&P, it could rather suggest that those tighter financial conditions will not only lock, but they could also worsen just a little bit, so as cementing the headwinds that the real economy will experience in due course, and quite likely portending a recession.
You talk about the currency. Many people are saying the downgrade is already priced into the lower rand. Do you believe it is?
So when people talk about the downgrade already being pricing in, I think they're correct when looking at financial markets. And for the most part, I would argue that yes, our credit default swap and even the currency and yields along the curve, for the most part, not completely, there's probably a last mile of smash to occur if we would downgrade, but sufficient to say that yes, financial markets have for the most part internalized the risk of a downgrade. However, our analysis and historical evidence suggests that financial markets convulse before the downgrade, the real economy smashes afterwards. And so the critical contribution, or at least we believe it's a critical contribution that we're trying to make, is that we should not consider this as already baked in, and so embrace the following few months with a level of detachment. If anything, the so-called man in the street impact is going to be realized in the following months and quarters, with the possibility of a recession, and then in turn that portends diminished income growth and job shedding. So perhaps the more tangible man in the street implications is yet to unfold and hasn't priced yet.
I was reviewing a presentation of yours, and I see the result of a downgrade on the job front would be another 200,000 jobs lost in the real economy, and that would obviously have a knock-on effect to 600,000 beneficiaries. You want to elaborate on that?
Of course. So we've already opened this year and christened it, according to Stats SA, with in excess of 350,000 job losses. I don't think the second quarter is going to be as glamorous at all. If anything, I think many firms would have been entering the risk of a downgrade with some level of mitigation, some level of fortification. And we're going further, and we're suggesting that the downgrade in itself, to the extent that it cements the financial conditions as it is tight and perhaps adds a layer of additional tightness, that is going to impinge on the real economy with, as you suggest, at least 200,000 job losses. And of course, if you consider a minimum of 3 dependents per formal sector employee, quite quickly you ratchet up to more than 800,000 people whose lives will be directly or indirectly blighted.
I want to stay with the rand, and I know it's so difficult to forecast this currency with the level of volatility, but there's so many businesses out there that are dependent on the level of the rand, and really it's just about being able to plan and to forecast accordingly. Nomura has a dollar rand level at 19 at year end. Given your sentiment, which seems to be more bearish, do you believe that that is the trend that we are going to see unfolding for the local unit?
If we were downgraded, it's entirely plausible that the rand could relapse somewhat. However, 19 rand to the US dollar, I don't think will be sustained. So I don't think that would be the value at the year end. I think we will go through a period in the immediate aftermath of this judgment, and quite literally next week and quite possibly the ensuing weeks, when we see a spike in the ZAR and even in yields. But a spike infers that it has its up leg and its down leg. Historically, the rand bleeds very quickly and grinds slowly in a recovery mode. So I would suggest that the delicate part is going to be in June and perhaps spilling over into August. But I would suspect that following bloodletting on the back of a downgrade by S&P, we'll probably go into the final quarter of this year with a sense of ZAR recovery and even some possibility that yields could trend towards, say, 9%. We must bear in mind that they're already at weak levels. The currency is cheap. Yields at, say, 9.5 for around the 10-year, just rounding, is already pricing in quite an elevated level of inflation risk. And if the economy slips into recession, yields, for example, will have to condition for that, and so your long end should tilt downwards. And I think, if we see 19 rand to the US dollar on a risk-adjusted basis, and to the extent that we coincide with weak equity markets, it would probably be a compelling proposition for foreigners to be entering the South African market, seeking correction or at least reappraisal and appreciation in the stock market, and also translation gains from the prospects of a recovery in the ZAR. So that weakness is its own reason or incentive to appreciate.
So a number being bandied about at the moment is purchasing power parity sitting at around 11 on dollar rand. Does that...
So purchasing power parity is certainly a helpful measure to give us some sense of fair value, but it has its own technical limitations. We would argue that fair value is probably between 13.50 and 14 rand. So it's just to give us a semblance of benchmark and how far we've dislodged, and so supporting my thesis that the currency at prevailing levels, let's call it 15.50, 15.60, going into this crisis, or at least in anticipation of the S&P result, is cheap.
As a financial journalist, I've got a sense of uneasiness. This is groundbreaking for us. We're in a pivotal moment for the South African economy, and this rating, the decision is very important, as you have taken pains to map out during the course of this discussion. You must have that same sense. This is enormous. I go back to what I said at the beginning of this interview. Something fundamentally could shift out of a decision. Do you have that same sense of unease?
I do. So personally, if one were to consider the manner in which we ascended 1994 in terms of our sovereign credit status, and if it was the single metric that captured our commitment to fiscal probity, our macroeconomic promise, and the Nelson Mandela era that suggested on the bedrock of reconciliation this could be a nation on its course to great things, captured in the sovereign credit status, which went from sub-investment grade all the way to BBB+, on the cusp of the coveted A category. to then have receded, and since 2012 slipped to today, where we're conjuring up the possibility of sub-investment grade. Of course, we've labeled it an arc of instability, an arc of failure. This is an indictment. It's an indictment on our political course. It's an indictment, frankly speaking, on the political choices we have made. It's an indictment on other social partners where we've had an inability to forge a social consensus that gives us a common goal. It's an indictment in the sense that the mass of citizens have not perhaps appropriately understood what the last couple of years has meant in terms of the absence of an economic policy, the quality of politics we've been exposed to, and what it would yield. So yes, at a personal level, this is certainly unwelcome. At a professional level, and look at it analytically, if you consider that had South Africa had a more benign path over the last 7 or 8 years, and I don't mean accounting for external conditions, if we even consider that the world externally has been less than a rising tide, just looking at the own goals, our idiosyncratic failures, we estimate that over the last 7 and 8 years, had we been more benign in our policy choices and more constructive in our politics, 1.4 million formal sector jobs would have been embedded into our economy.
1.4 million formal sector jobs
is what we have foregone because of our clumsiness. And we estimate that cumulative GDP lost over the last 7 or 8 years is just in excess of 1 trillion rand as a function of domestic dynamics. So when you judge it through that lens, the output foregone, the jobs foregone, the potential lives, in excess of 5 million lives that would have been better if South Africa was more constructive in its social dialogue. And then that can be pretty depressing.
It shows the enormity of the situation that we face.
But it presents us, rather than looking through the rearview mirror and singularly lamenting our condition, for saying, this is the cost. At what point in time do we confront our challenges more feverishly? And perhaps this S&P downgrade allows us to go through the eye of the needle and suggest we need to engage with our politics, our policies, more stridingly, more unforgivingly.
You're an economist. You like statistics and forecasts. What's the probability of the downgrade?
I am going to suggest that even though it's hours before, it's likely to come to pass. But I say that very hurriedly because I want to go on to say that it would have been sensible for any South African firm or even a household to go into this environment, and to the extent they can, with some level of fortification. And then take it even slightly further by saying whether it happens or doesn't. If 2016 turns to be an inflection point, then South Africa will have achieved something by the debate, by the conversation, irrespective of the outcome. And perhaps after the municipal elections, the ANC also, as the party with the most substantial grip on South Africa, despite the opposition parties over the recent couple of months having had quite a shaping force, the ANC is still the party with the most substantial grip on South Africans' fortunes. And if it exits this, especially after the forthcoming elections, with a greater sense of construction, then not all will have gone to waste.
Goolam, thanks for your time. I've been chatting to Goolam Ballim, Chief Economist at the Standard Bank Group. You're watching CNBC Africa.